Yes, your brother-in-law might have ideas on how to sell your business, but why don't we talk to somebody who's actually done it?
Welcome to the Navigating Abundance podcast. Our goal is to encourage you to pursue your total family wealth potential through insightful conversation with experts and thought leaders in their fields. But first, some obligatory disclosures. Navigating Abundance podcasts do not represent investment, legal, or tax advice. Any opinion expressed in Navigating Abundance podcast is solely those of Christopher Tanke and his guests and are based upon information believed to be reliable but not guaranteed. Podcasts are produced for educational and entertainment purposes only and should not be considered an endorsement of the guest or the views that they hold. Information shared may not be appropriate for your personal situation. Consult a qualified advisor for guidance. Investment advisory services are offered through Strategic Financial Group, LLC, a registered investment advisor. Navigating Abundance is a trademark of Strategic Financial Group, LLC. And now here's your host, Chris Tanke.
Welcome back to Navigating Abundance. I'm Chris Tanke. Join us today as we continue our conversation on straight talk on selling your business with Michael Walters of USA Financial Securities. I know you're going to enjoy this episode.
We wanted to make sure that the group that was investing in us was bringing something more than just capital. And you know, they are bringing that leverage, which we already talked about, but we also wanted there to be some economies of scale. And the way we went after that is, and I think most industries could probably have the same conversation. There are things that we do that are very unique to our industry, that are truly industry specific job functions and offerings and services. And that's really what makes you who you are in your space, in my opinion. Then there are other things that you do that every business has to do: accounts payable, accounts receivable, you know, the kind of generic business stuff. So with our deal, we're offsetting a lot of that behind the scenes generic stuff, so that I could take my team and hyper focus them on the things that really matter inside of our industry and to help us grow and so on. So for example, our accounting team and our financial team internally, they are hyper focused now on operating the industry commissions and the industry payment systems and all the things that are unique to us being able to support financial advisors out in the space as they deal with their customers, their clients, and their investors, as opposed to that accounts payable, accounts receivable stuff.
Yeah.
And our legal department is the same thing. They were covering all of our general, legal things that you need as a business, but their real value is in what's called compliance in the financial industry, all of the compliance and the regulatory oversight and things of that sort. So we pushed all that generic business stuff off to the other group, and we kept hyper focused on the things that are unique to our industry. So, and again, what it allows you to do is grow more rapidly with the same team you have, and your team's expertise already, so you're kind of dialing them in to the things that really matter. And then again, the stuff that was kind of the busy work, I'm pushing off to the other group.
And the stuff they're doing now is more fun anyway.
Exactly. It's the reason.
Yeah.
It's the stuff they enjoy most.
Exactly.
Yes.
Right. I love that.
Yep. And then for us, and this one's probably pretty unique to us, is we were looking for capital solutions to assist other groups who work with us, people like yourself and other financial advisors and asset managers and things of that sort, who were also interested in M&A and how do I monetize my business over time and so on. So we brought in this group not only as our capital partner, but so that we would have capital to invest and acquire and help other groups monetize what they've been building as well. So that was an important piece of us. Again, that might be a little more unique to us than it is kind of generic across all industries, but it could happen in any industry depending on how you're structured. But so I spend a lot of my time, I did before we did the deal, but now since we've done the deal, I spend a lot of my time working with other business owners to help them duplicate or do their version of what we did. And that's fun for me because these are, for the most part, people I've worked with for the last 5, 10, 15, 25 years that they've built their company right alongside, kind of in partnership with us. And now for me to be able to step forward and kind of guide them and be their Sherpa to walk them through, here's how you can monetize probably the biggest asset you have in your life, which is the ownership of your business.
Yep.
here's how to, here's how to approach this. So I spent a lot of time doing that, and now I've got the horsepower with the capital of this group to help me do it even better.
And
so that's really
you can
cool.
tell them all honestly, here's how I can save you $2 million.
Yeah. Yeah, exactly. 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 And then lastly, which I think is probably just one that everybody should think through, is, we wanted to make sure that it was an overall right fit, that we had similar cultures, that we had similar moral standards, that we had the same intent, and we were really going after the same things in the same way. I didn't want to change who we were just to do business, with this new group kind of under their umbrella. So the fact that they saw the world the way I see the world and the way our team sees the world was really important as well. So if you were counting, that was my 7 bullets or my 7 items that we had.
Yeah. It's, okay, you pour your life into your work, and all of you business owners know profit is wonderful, but it's so much more than that. It's you. It's your life. It's your mission. It's your calling. It's your passion. And when you hand the baton over to somebody else, you want to make sure they're not going to screw it up. You want to make sure that business, basically outlives you, and understanding the culture and understanding, the mindset of those purchasing you, how that's going to affect your team. Having these conversations, if you can find yourself in alignment with purchasers that are going to perpetuate what you've built, that's so much more satisfying. And to me, and again, everybody's different. Maybe if you get an extra, $20 million, if you don't worry about that, maybe that's important to you. But most people that I know that I talk to, it is important to them. They'd rather forego the extra $20 million to make sure that their staff, to make sure that their vision, to make sure that their systems, their impact, their reputation, all of that goes on and lives on. That means you have to find the right person. It's like getting married, right? You don't get married to the richest man or woman, right? You get married to the right man or woman. It's a lot cheaper in the long run.
That's for sure. Yeah. And a lot less grief.
Very good.
But the other part that kind of goes hand in glove with that too, Chris, is if as a business owner, if you haven't already started thinking this way, hopefully today's the day you start to think this way. You really serve 2 roles. You are an operator. You're there running the daily activities of the company, or the people who are reporting up to you, however it is you've got yourself structured. But then you're also the investor, whether you're the only owner and you're a sole investor, or you've got partners or whatever it is, but you really wear 2 hats. You've got the operator hat on, you've got the investor hat on. And it's important to start realizing those are in fact 2 different hats, and you need to look at them separately and differently. So if you're in a quarterly board meeting, and maybe the quarterly board meeting is with yourself because you're the only owner and the business is, of the size that you don't have others involved or whatever. But when you sit down at that point, you should be sitting down as an investor. And you might be getting reports from the operations side, but you're sitting down looking at this thing as an investor. And are we going down the right path to create wealth on the P&L side, or on the balance sheet side of the business? Mm-hmm. And then at the operator side, it's almost more like you're on that P&L side of the business. Mm-hmm. I'm worried about, the revenue coming in, the expenses going out, and what do we get into the bottom line? Mm-hmm. And obviously they're both very important, but you do need to separate, because again, there's a very good chance when someone buys you that they're only interested in the investor side. They don't want to wear the operator hat. In our case, they want me to keep wearing the operator hat, or they're going to replace you with an operator that they're going to literally hire to run the business, but then they're the owners of the business or the investor in the business. And so getting that mindset separated can be super important. And one of the ways I say it kind of without saying it, and you've probably heard me reference this before, but I think in West Michigan, it kind of resonates because of some of the big businesses that are around here. But there is a huge difference between a family business and a business owned by a family. Those are 2 very different things. A family business versus a business owned by a family. So a family business is Joe's Pizza Shop down at the corner, who is employing the spouse, the kids, the son-in-law, and really just kind of like running the business to make a living. Then a business owned by a family, think Amway, think some of the large furniture companies in town, think Meyer, think of in the financial world, think of Fidelity. Those are businesses owned by families. They're not publicly traded, they're privately owned, but they're not thought of like Joe's Pizza Joint. They're run as a business owned by a family rather than a family-owned business.
Very good. Okay, those are some of the things as we talked that you're interested when you're kicking the tires of a potential buyer. Some of the things that you need, want to make sure that you're not going to sacrifice as you hand over the baton. But what about the buyer looking at you? You mentioned here that there are some data sources that investors or buyers will be looking at, asking for, requiring as they kick your tires. What are some of those data sources?
Yeah, the way I usually explain it to people is there's 3 points in time, and each one of those 3 points in time comes with three views of data they're looking for. So there's yesterday, today, and tomorrow. And then yesterday, they want to see your P&L, pretty basic stuff, your profit and loss, your balance sheet, and what do your growth trends look like? So those are the three things that you kind of have to have in order, if you will. Now, in that P&L, what I will say is look around in your industry, and today you can ask AI, ChatGPT, you can Google it up, whatever. But every industry kind of has its expected margins or its expected percentage of EBITDA. So if your industry is supposed to get 20% EBITDA, and you don't have 20% EBITDA, but you're also pulling a very healthy living out of the company, you might be overpaying yourself as an operator, which is the reason you don't have a lot of EBITDA, or vice versa. So there's a balance between those, because a lot of times I talk to businesses and they're like, well, we don't really have any EBITDA. But then I look back and I see that, well, yeah, but you're paying yourself 3 times what a normal business if they were just hiring a hired gun to run the business, they'd be paying them significantly less than you're paying yourself.
Right.
So again, there's nuances in here, but they're going to be looking for your P&L, your balance sheet, and what do your growth trends look like in terms of yesterday. In terms of today, it's going to be talking about what are called add backs, normalization, and then any economies of scale that can be had. So add backs are things that affected your EBITDA, your P&L, but were like a one-time situation. So maybe you made a big investment in technology, or you bought a bunch of new equipment, or whatever the case might be. It set you back today, but the reality is that's going to last a long time. It was a one-off. It's not something that's part of the normal. So you'll actually get it kind of added back into your deal, and it will increase your EBITDA with that add back. And then normalization, I kind of almost alluded to it a moment ago. Normalization would be like if I'm the owner and I'm paying myself twice what I should, then normalization would be, okay, well then, if we had to hire somebody to replace Mike, we're not going to pay as much. So therefore we've got this other piece. Or another way that you see it happen, and probably even more so, is if you own your own building. Most of the times, you're not going to have your building owned by your company. You're going to have a separate LLC for that, but you're paying rent to yourself.
Right.
And maybe you're paying more rent to yourself than is the going rate. So that's going to have to get normalized back into the deal as to a going rate, because an investor is not going to overpay on rent because they don't necessarily own the building. Now, maybe if they also buy the building from you, then maybe that works. So again, normalization would be kind of leveling these things out. And then obviously economies of scale is hey, depending on who's buying you, there's opportunity to get economies of scale there that don't exist when you're freestanding. So those are going to be analyzed in kind of today's spotlight. And then if we go to tomorrow, there's 3 more. Tomorrow, it's about, what can we honestly project your future profit margins as, especially after we get done going through the today's stuff. So how does that change your future profit margins? What's going to happen with future leadership? So in my case, I plan on sticking around for quite a while. But if I don't, then that has to get planned for. Or is there a certain transition time? Maybe there's some golden handcuffs involved where I have to stay around for a certain period of time because I'm grooming the person who's ultimately going to replace me, or whatever the case might be. And then lastly would be the growth projections. And again, that's based not only on your historicals, but also on, what can be done with you being part of this new group, whoever it is that's buying you, what do the new growth projections look like? Because they're probably slightly altered from what the old growth projections look like. And done correctly, they should be better, not worse. So, when you're going through a deal, one of the other things I think is pretty cool is that the best deals, in my opinion, are the deals where the company being sold is worth more to the buyer than it is to the seller. If the opportunity, if the transaction is truly worth more to the buyer than it is to the seller, everybody's going to win every single time. If it's the other way around, if the seller's trying to get, gouge every ounce of flesh out of the deal that they can, and the buyer's kind of hesitant on the situation, that's when the red flags start going up. But when that's reversed, like for us, like we're running a really good business. But for us to exist inside of AmeriLife, to become a wealth platform for them, which they were desperately in need of, and they have all these opportunities for economies of scale and leverage throughout their existing universe, like they can get profits and value out of USA Financial that I cannot get myself on a freestanding entity. And so suddenly I'm worth more to them than I am to myself, and that makes a really good deal.
Yeah. To search somebody out that is going to have those opinions of it is I can see the great value in that. Mike, we're against a hard stop that you mentioned in 7 minutes, but I've got to ask you, you think in 7 minutes or 6 minutes you can talk about the 4 ways to spread the wealth? Boy, am I interested in that question. 4 ways to spread the wealth. So the deal's been made, so to speak, or it's going to be made, and here's how you're going to be making sure that everybody's taken care of. How's that done?
Yeah. So, and you can, again, ideally, you should be thinking about this before the deal happens, and in many instances, years before. So we made those decisions years before. Back, in fact, actually in 2008, 2009 is when we put together. I mentioned it earlier in the conversation. We put together a phantom stock program.
Yep.
So we used phantom stock to spread that wealth. We wanted our people to have skin in the game. We wanted to reward them. We wanted our success to be significant to them beyond their typical paycheck. And so we use phantom stock. So I would say that's one of the ways. If you are looking at like you're under the gun, and let's say you don't have time because now you're up against doing a deal, you don't have history and you can't back up and issue phantom stock or whatever. What we're seeing a lot of times is forgivable loans being used. So in other words, if I go to do a deal and I've got some key teammates that I absolutely want to stay with me over the next 3, 5 years, 10 years, whatever it is, and they're integral to the deal, but they didn't have ownership in the past, but I want them vested for the future, I might do basically like a forgivable loan. In fact, a lot of times you'll see this happens in recruiting, in hiring, and it happens in the medical world a lot when a hospital brings in a new surgeon. Instead of giving them a quote signing bonus, they'll give them a forgivable loan. So it's, in other words, you give them money up front. Right. And if they stay with you over time, it gets forgiven. Yeah. So it also spreads out the tax burden because it's not taxable to them, generally speaking, until it's actually forgiven because it's a loan otherwise. Right. So as it gets forgiven, you spread out the tax burden. So maybe I forgive it over the next 5 years or whatever. So forgivable loan would be number 2. Number 3 is what are called profit interest units. And profit interest units, if you think of a scale, if phantom stock's over here and actual direct equity ownership is over here, in fact, maybe let's jump to that for a second. Direct equity ownership would be one of the other 4, where I'm actually giving them ownership in the company. Maybe it's a separate share of separate class of stock because I don't want them to have control. I don't want them to be able to outvote me ever, but I am comfortable with them having ownership. But keep in mind, if you're going to give away stock and those people leave you, you may end up with owners who are not part of your team, and that could be problematic. Now, there are ways to potentially claw that back, talk to your attorneys. There are ways you can structure different things, but you've got true outright equity ownership there. So now you're talking capital gains on phantom stock, you're talking taxable income. And in between that is a thing called profit interest units, which is probably the least known solution that's out there. And a profit interest unit is kind of like you draw a line in the sand and you're giving someone essentially ownership in the future growth of the company. So not all that different from phantom stock, but it's a little more, it's got more teeth in it. And so because of that, like if you do a dividend distribution, the profit interest units would participate in that. So it does treat itself more like actual stock. And then because of that, it does fall in the capital gains category as well. But you can also do more of those clawbacks like you can on phantom stock. So it's kind of, I don't know if a tax attorney would explain it this way, but as a business owner, I would say it's like if phantom stock is here and equity ownership is here, profit interest units falls in the middle. So those are the three kind of equity pieces. And then that fourth piece is that forgivable loan that we talked about.
Wow, very good. My goodness. It was so much easier. So much easier. We were just the employee.
Yeah. Exactly.
Well,
but you know what? Good problems to have, right?
Yeah, that's right. They're good problems to have, but they're problems nonetheless. So I do appreciate this really kind of a stewardship conversation that we've really had, because again, in the end, it's so much more than money. It's so much more than a big payoff. There are people involved with this. There is your life work involved with this. There is a reinventing of yourself after all of this involved with this. I mean, my goodness, this isn't going to be solved in a half-hour conversation with your attorney, that's for sure. But boy, wonderful, wonderful advice. Michael, we're going to put your contact information up, and I'm going to request that you be open. If somebody wants to talk to you, at least you could talk to them shortly, right? And maybe direct them where they'd want to go, because that's kind of your nature anyway. So, so if you want to get a hold of Michael at USA Financial, we'll put that up there for you. Again, a great resource, especially if somebody is in Michigan. You've got people they can plug with, perhaps, and get some of these things solved for on a professional level. Any closing comments here?
No, I think that probably the last thing I'll just leave you with is, if you think that succession, transition, merger, acquisition, if you think that's in your future, and it's in your future within the next 5 years or less, you need to get moving now. I would say to do this stuff right, you need a minimum of 3 years, and most people would probably tell you 5 years. If you're scrambling and think you're going to whip this thing together in 6 months, it just simply ain't going to happen. Mm-hmm. To do it right, make sure you're planning ahead.
Very, very sage advice. Well, Mike Earl Walters of USA Financial Securities, thank you so much for investing some of your time in us and our listeners. Appreciate you, Mike, very much. Have a great day.
Absolutely. Thanks, Chris. Right. Talk to you again soon.
Bye-bye.
All right. Bye-bye.
Thank you for joining us for today's episode of Navigating Abundance. If you found this information useful or helpful in any way, let us know in the comments section below. If you'd like to see more content like this and follow our podcast, you can find us on all major podcast platforms. If you're interested in working with today's guests, you can find their information in the description of this podcast. If you'd like to know more about Navigating Abundance and how we may help you, or find more resources related to what we do, you can find those at navigatingabundance.com.